Hi, and thanks for watching. Today we take a glimpse into fintech and one of the potentially most disruptive platform media markets, equity crowdfunding, which challenges the fundamental values of traditional investment analysis. But to start, let's first ensure that we have a common understanding of platform mediated
Markets exist when a buyer and a seller come together. In the past, most of the time, that would have been physical markets. Nowadays, it can be digital platforms such as iTunes or Kickstarter. Artists or founders are selling their product to consumers or backers. Each of these actors have different abilities and limitations. A model explaining this in detail splits the market up in four roles. Naturally, the producers and the consumers. But the platform on which they buy and sell is split up into two parts as well, the provider and the sponsor. Taking the previous examples, the sponsor of iTunes and Kickstarter are Apple and Kickstarter respectively. They own the platform and can control and decide what the other actors on the platform are allowed to do and what not. The provider on the other side provides the interfaces that allow access to and interaction with the platform. For Kickstarter, this is any device that allows the access via a browser or app to the platform, so a computer or a smartphone. Building on this, another example of platform-mediated markets and the topic of today's video session is equity crowdfunding, which presents a form of equity financing in early-stage venture markets. Traditionally, entrepreneurs have access to two sources of capital when founding a business. On the one hand, auto-financing, which includes their own money and contributions from friends and family. It is used to cover the very early costs, such as building a prototype and renting the first cloud server capacity. On the other hand, external funds can be raised as follow-on investment once a startup has demonstrated its basic feasibility and the potential to offer high returns on investment. However, before attracting the interest of VCs and angel investors, most ventures experience a funding gap. In plain English, they run out of money and are unable to continue their business operations. Following the financial crisis in 2007 and 2008, the funding gap was particularly strong since banks became more conservative in their risk assessments, which restrained them from providing working capital loans to early-stage ventures. This made it impossible for some ventures to bridge the time between auto-financing and follow-on equity investments, and made many promising businesses cease to exist. Having acknowledged the shortcomings of traditional sources of venture financing, global institutions and entrepreneurs have crafted innovative concepts to make early-stage capital widely accessible. Equity crowdfunding platforms operate in a similar fashion to the aforementioned reward crowdfunding platforms, such as Kickstarter. Only that investors do not receive rewards in the form of vouchers or physical products in return, but an equity stake in the company. Unlike traditional financing counterparts, equity crowdfunding offers venture exposure to a larger pool of investors, also across borders. Moreover, investors benefit from small investment requirements and can thus diversify their portfolio holding to effectively reduce downside risk.
Let's have a quick look at some success stories. One of the largest fundraising so far in Crowdfunding was Chilango, which eventually raised £5.4 million. It's a Mexican restaurant food chain which used the funds to expand its operation from London to other cities around the world. Another campaign to look at is Monzo. What makes Monzo so special is that they were the fastest fundraiser on Crowdcube to reach their initial target of £1 million. They managed this in 96 seconds. If you think about it, 96 seconds is 1/5 of the time to watch our entire video. So I would say this is quite impressive.
Yeah. Okay. Equity crowdfunding emerged as a response to the funding gap. Why do you think was an internet technology approach the most dominant response to this problem?
Funding is about risk-reward, right? And what you see that, especially highly innovative companies that tend to use crowdfunding most, they need investors that have a risk appetite that corresponds with the risk profile of the company. And what you see that traditional financiers, to a large extent, just don't have the risk appetite of these companies. So what do you need to do? You need to install or implement measures that invest with a certain reward appetite or return appetite, matches with the risk profile of the company. And what you see is crowdfunding basically does, it distributes the risk to a large pool of people. So internet technology makes it really cheap, makes it really efficient to address or reach this large crowd.
How can an equity crowdfunding platform gain an advantage over its competitors?
It's hard to say at this point because the market is still evolving. The growth seems to be still the most important driver of success. So the first mover advantage, having the most or the largest addressable crowd. If you ask me in the long run what would be the dominant factor, I think in the end it will all come down to cost efficiency.
How does Symbit differentiate itself from other equity crowdfunding offerings?
And then Symbit still has the benefit of timing, so it was one of the first equity crowdfunding players in the world, and therefore has made already a lot of mistakes, helping us understand what works and what doesn't work. The market is not yet at the point that cost efficiency and bringing commissions down is the main factor driving success. The main factor driving success is at this point the chance of getting a successful closing.
Despite its current hype, equity crowdfunding is not all gold. Less than 2% of all funded ventures provided its investors a payout. This does not mean that crowd investors necessarily lost their investment. Actually, only slightly more than 2% of all funded startups filed for bankruptcy. But since the majority of companies has not attracted follow-on investment, and there are no secondary markets yet in venture ownership can be traded, There's a lack of data to effectively evaluate the success of equity crowdfunding as of now. Nonetheless, many researchers and practitioners contest the feasibility and sustainability of equity crowdfunding for two reasons. First, the investors' clientele, as compared to VCs and angel investors, lacks financial literacy, and the average contribution is too marginal to vindicate exhaustive due diligence. Such an environment likely suffers from severe asymmetric information and potentially results in a lemons market, where only distrustful and less aspiring startups seek for financing. Second, crowdfunders invest in an investment vehicle that offers hardly any alleviation of moral hazard, such as in the form of anti-dilution preferences or tag-along rights to the investment contract. When taking a look forward into the near-term prospects of equity crowdfunding, this leaves us with two questions. Question 1. Can asymmetric information be sufficiently alleviated to evade a future lemon market outcome? And question 2. If such a scenario is avoided, how can individual platforms develop a sustainable and profitable business framework?
In order to address the first question, we want to refer to this master thesis regarding the impact of quality ratings in equity crowdfunding. The paper researches the value of crowd rating to the investor community. Crowd rating is an independent due diligence provider that assesses the risk-return trade-off of ventures that seek for financing on crowdfunding platforms such as Crowdcube and Seedrs along 9 dimensions. Where the paper fails to find a consistently positive and significant effect of each risk dimension on the reduction on asymmetric information, the rating in aggregate and particularly the product-related dimensions seem to educate crowd investors and improve their investment decision-making. In this sense, we are confident that new innovative solutions will emerge and the lemons market outcome can be avoided. So coming to question 2, how can individual platforms develop a sustainable but profitable business framework? As pointed out by research, it is crucial to determine the right money side, so the party of the transaction that is able to monetize the service and willing to subsidize the other side. Equity crowdfunding platforms currently charge ventures 6 to 8% of successful fundraisers and grant investors free access to the network. Given the popularity of many platforms, this pricing strategy seems to be set correctly. A second factor that shapes the long-run feasibility of equity crowdfunding and decisions regarding to closing and opening the two sides of the platform. In order to alleviate information asymmetry, supply-side access, so the accessibility of the platform to funding ventures, should be restricted by careful due diligence. On the demand side, the platform should be open to benefit from the wisdom of the crowd. This rationale stipulates that a larger number of investors should derive more balanced and more informed decision-making. This effectively reduces asymmetric information and enables platforms to operate a sustainable and profitable business. So what makes equity crowdfunding relevant to you? Regarding this quote by Simon Sinek, as a digital native, you cannot only follow your passion and dive into new innovative business models, but at the same time, equity crowdfunding also allows you to earn a lucrative financial return. Thanks for listening.